Hi, this is Jim Cunningham. I have Christina Lindsay Orta from Ascent Wealth Management and Austin Fitch from Horizon Investments joining us today. Very important topic, market update. So we're in mid-2023, and I know, Austin and Christina, that I'm really concerned about this because I have a 401k and I'm invested, and I look at this and I think, oh my goodness, things are going up, things are going down, recession, interest rates, scary stuff, right? So we're going to talk about, well, I'll turn it over to you, Austin. What are we going to talk about?
We're going to talk about a lot, Jim. Yeah. And thanks for having me. There are so many things kind of going on right now. I think as we've talked about in preparation for this meeting, just how quickly the market is moving with some of the items here on the screen. Inflation, you talked about the Fed. We've talked about, is the inflation run that we've seen over? Does that mean that the Fed can stop, hiking interest rates? We'll talk a lot about both of those. We'll talk about the U.S. consumer, Jim. I think a lot has been made, or maybe not been made, about whether or not the consumer can really kind of keep the economy chugging along. So we'll get into that. And then number 4 there highlights. Okay, so what does this all mean, right? We can talk all day about kind of the economics behind it, but to your point, how does that actually affect my 401k or my IRA or my retirement account? That's that outlook piece that we're going to touch on at the very end, because it's great. We can talk about inflation, and whether it's 4%, 5%, 10%, doesn't matter. But what does that mean for the stock market, right? That's what it really boils down to. So we'll get to that as we get into the end.
Great. Well, I'm Jim Cunningham. I'm a partner at CunninghamLegal. I have more than 25 years experience. I think when you hit 25, you just say it's more. We have offices throughout California. I'm a certified specialist in estate planning, trust, and probate law. I'm a real estate broker. I'm securities and insurance licensed, and a pilot. So lots of different activities. We have a whole bunch of lawyers at our firm, over 10 lawyers now, devoted to estate planning, trust, and real estate matters. So helping individuals and families with these sort of transactional type matters. I've got Christina Lindsay from Ascent Wealth Management. Her partners, Alyssa Kroger, Shannon Behan, and John Lindsay, are also part of the team. And it's a great team. And other than your dad, John Lindsay, it is an all-female team there, right? It's really kind of cool. So
it is.
And then we have Austin, and you're in North Carolina today. And you all, both of you were up in Maine or something, weren't you? Just day before?
Yeah, yesterday? we were in Vermont yesterday. I got home at 2 a.m. this morning from doing an investment forum with Austin and a lot of the members from his team at Horizon and some other advisors. So it was a good meeting, good time to kind of get some feedback on what they're feeling the market is doing, what their outlook is, and as well as some other advisors across the country. So one of the things that Horizon helps us do, they kind of act a little bit as an outsourced chief investment officer for our firm, and they help us construct some of our model portfolios, as well as provide us insight on where they feel the puck is going with the market. So they're an integral partner for us. And so want to make sure that everyone has some context as to how we work with Horizon. And without further ado, we can kind of get into what your
Great. So if you're watching this on YouTube, please hit the subscribe button and the little bell, and you'll get alerted. I'm a lawyer. I'm talking. Please do not listen to this and go out and do a bunch of stuff just because I said it or somebody else said it. You need professional advice, not something you just want to go, yeah, I heard Jim say it and I'm going to go out and do it. Bad idea. And also the securities offered through Christina's broker dealer, which is the kind of a regulatory thing, part of her team, I guess.
Yep.
They also, this is their disclosure. I don't know if you want to have a word on that.
Yeah, we're registered with Cambridge for FINRA and the SEC. We have our own registered investment advisory firm with Cooper McManus. So definitely know that this is not individualized investment advice. So we're just trying to kind of give some context here as to what we think the market is doing.
Great. Well, I do want to touch on, maybe we can do that at the end, how, this is probably a topic for a different webinar, but what's Austin's role? What's your role? What's, Cooper McManus, all these names, what's going on? Folks, this is a heavily regulated space, and most advisory firms have these segmented roles all kind of working together. But the point of contact is Christina. it's Shannon, it's Alyssa. So if you call into Ascent Wealth Management and you say, gee, I'd like some help with this, you're going to be talking to Christina. You're not going to be talking to Austin. Austin won't take your call because he has no individual clients, right? And it's really a regulatory thing. So his efforts are kind of channeled through Christina, and then that's there to help you. So I will let the two of you take it away. And we're starting with inflation. Kind of scary.
Yeah, Jim, I think what we've seen over the last, at this point, 3 years from an inflation standpoint is unlike anything we've seen in 50 years, right? So I think what we're talking about now and the data that, so we put some of this on the screen, but I think for those of you that are listening, what you're seeing or what we're showing is this idea of the data is actually starting to show you that the inflation story, it's really already been written and we're just kind of catching up to it. And for those of you that aren't familiar with kind of these CPI numbers, consumer price index, what that really is it's a backward looking measure. So all that tells us is where we've been. What we're more interested in, and Christina just alluded to it, is, okay, where are we going? Where's that puck going? And that's where we want to think about how do we manage money? How do we think about looking at where markets will go? And that's where you want to look at more leading economic indicators or leading indicators when it comes to making decisions. So whether that's the producer prices index, whether that's some job openings data, whether that's small business pricing plans, any and all of those are seen as kind of leading indicators. They tell you where inflation likely will be going in the future. And what you see is if you actually look at that data, all of that data has actually already come down and in many cases is below where it was going into 2020 when this inflation story really started. So what does that mean? Well, that means that likely, more often than not, history would tell you that the CPI number, the inflation number that we've all been talking about for 3 years at this point, is likely rolling over in the future as well. Again, being backward looking, we're looking for, okay, what does it mean for the next 12 months? Well, the next 12 months, that leading data would actually suggest that that inflation number is going to continue to come down. We've seen it come down a little bit, right? We all know that. The question is, where is it going to go from here? And the preliminary data would suggest that it's likely going to continue in that direction, which is actually a good thing, broadly speaking, for the economy, but also leads then into, okay, does it allow the Federal Reserve, which controls interest rates in the U.S., does it allow them to maybe take a little bit more of a back seat? Do they feel like they no longer have to hike interest rates? But again, looking at that data of where we're going to be is, I would say, eminently important, as opposed to just looking at that inflation number that may feel kind of high, but it's just telling us where we've been.
Well, Austin, I got to tell you something. Like, I probably shouldn't drink Diet Coke, but I do. And then when I go and I look at a 12-pack of Diet Coke, it used to be like, I don't know, $5 or $6.
Yep.
Now I'm going in stores, it's 10.
Yeah.
Some stores, right? I mean, there's like normal grocery stores. It seems that companies have really taken advantage of, like, especially the really big companies, they've really taken advantage, it seems to me, of raising prices. Is it that their costs have gone up? Are they making more profit? What are the big companies? Are their profits increasing because of this inflation, or is this a reflection of the cost to produce the goods? Just broadly speaking.
So there's a little bit of all of that, Jim. Yeah. I would tell you, and really, I guess what we've seen is a lot of those price increases have taken place over the last 2 to 3 years, depending on the good itself or the service itself. Kind of depends on when the price increase really flowed through. But yes, it's been the goods themselves, the costs to get those have gone up. You saw a really big supply chain disruption, right, during COVID. That was a pretty big deal in terms of actually getting the goods and services. And then we'll talk about this here in a little bit. But just the labor market, right, and the shortage that we've seen there has been a really big deal in terms of manufacturing a lot of goods, and especially on the services side. So that has been one of the big drivers from an inflation standpoint. I think what I would tell you is, on a go-forward basis, the good news is, at least everything we're seeing would suggest that your Diet Coke's not going to go from $10 to $15,
That's
right?
Good.
It may flatline and kind of remain at that $10 threshold. Now, we're not suggesting deflation by any stretch, so it's unfortunately not going to go back to 5. But it's also, like I said, we're not going to go from 5 to 10 and then 10 to 15. So.
And Austin and Jim, on the prior slide, that was just kind of breaking down just the different sectors of inflation, because there's the core CPI index, and those are the numbers that everyone hears. but there's really the different types of inflation, and it's goods, it's services, it's housing. Whereas, goods have kind of rolled over. People aren't buying, 10 packs of toilet paper and Clorox anymore. And so the goods cost has come down. Housing has started to roll over. And then, that's really kind of what we're starting to see. And then the NFIB, if you want to explain that one a bit, Austin.
Yeah, no, that's a survey of small businesses, basically. And really what that means is what's their plan for what they're going to do with prices on a go-forward basis. And again, you saw, if we look back at where we were in 2022, and Jim, this kind of goes to your point, small businesses were saying, hey, we're raising prices, whether that's because labor costs more, whether that's because the goods to get, the individual items cost more, or Jim, to your point, whether they could, right?
Yep.
They could get away with it to some extent, right? Some companies were doing that and were able to juice the bottom line. We'll actually see that in a little bit as we talk about some of the earnings that we're seeing. But that pricing plan is a survey that says, hey, what do you plan, 12 months from now to do from a pricing standpoint? Is it going to be the same? Is it going to be lower than it is today? Is it going to be higher? And what you're seeing today is it may be marginally higher, but it's not going to be anywhere near as high from a 12-month forward look as it was in 2022 when that survey was out.
Let me ask you, is inflation good or bad for investments? Like, is it better to be in a low inflation? Is 2% better than 5%, or does it matter?
I would say it this way. We definitely want some inflation. We clearly don't want deflation. 5% and above, we'll say, is probably challenging for lots of reasons. In that 2 to 3, 4% range is kind of what you would think of as normal inflation, right? If you look at the target range that the Federal Reserve is really looking for, that's kind of in that 2 to 3% range. And really what that means is over time, that allows, cost of goods to continue to increase marginally, but not substantially. What we lived through the last 2-3 years has been substantial price increases. And that's where it can be a shock to the system. Right. It can cause, challenges for lots of different, consumers, businesses, individuals. And that's where it starts to get challenging, is once you get past that kind of that target range into the 4, 5, 6%, that's where it creates some issues.
So if you want to explain this a bit, Austin, and then also kind of, I think the question of the day is what the Fed, is going to do. Because I think what they did yesterday was what everyone expected them to do, was to take a pause. They're still signaling to the market that there's more ahead. And so I know we've spoken about that. And I think that there's the hardest part being an advisor and being someone that handles money these days is there's not a lot of consensus out there as to, is the Fed doing one more hike? Is the Fed doing 2 more hikes? I think that what we can all agree on is that we're in the 9th inning.
Yeah. Yep. No, I think you're absolutely right, Christina. And so the previous slide is kind of underlying economic data that we can all kind of get our hands on. What's really interesting, though, is to think about it in the way that the Federal Reserve thinks about it. And why that's important is because they're the ones that set interest rates, right? They're the ones that decide, do I need to hike interest rates or cut interest rates? And at the end of the day, it doesn't matter what we at Horizon think interest rates should be. It doesn't matter what Christina and her team thinks interest rates should be, right? It really matters, what the Fed says and what they decide to do. And the good news there is the measures that they track. So they track what's called the personal consumption expenditures, so the PCE there. And what you're seeing is that data is also starting to come down. Christina talked about goods inflation rolling over. That's one of the small charts there. You start to see that, it peaked in 2022. It's coming down now as we get into 2023 from a trend standpoint. Same thing if you look at the service sector, right? And if you think about, the inflation that we saw in the service sector, that actually happened post goods inflation, right? We saw goods inflation first, then we saw services inflation. You're also seeing it on the housing side. So that's the third component part. The fact that all 3 of those component parts are starting to roll over, and that's what the Fed monitors and the measures in order to set interest rate policy actually gives you a good feeling of, okay, so what does that mean that they're going to do on a go-forward basis? Again, we're always focused on what's coming. And the next slide actually, Jim, I think does a pretty good job of showing us really where we think rates will be kind of in the future. So we're looking at where does the market, so looking at a futures kind of distribution of where the market thinks interest rates will be at the end of the year. It's actually telling you it's likely going to be pretty close to where we are today. To Christina's point, maybe there's another 25 basis point rate hike priced in. Some people are suggesting that we see interest rate cuts. What's interesting though, the gray shaded area, so we're looking at a distribution. Again, for anybody listening, not seeing the screen, we're looking at what is the Fed telling us and what are markets expecting? And what does that distribution tell you? You have some people that suggest that the Fed needs to start cutting interest rates. At Horizon, we are by no means in that camp. You have other people that are higher than where rates are today. That would suggest that maybe there's another rate hike or two still to come. But what it really tells you is the fact that we're kind of right there, kind of on that sweet spot in terms of what the market's pricing in and really where we sit today. Now, as we talked a little bit about in preparation for this call, if you get significant divergence from that, really in either direction, that could surprise the market. So if you get a Federal Reserve that hikes interest rates 2, 3, 4 more times in the back half of 2023, that's going to surprise the market. Probably not ideal. It's additional headwinds from a market standpoint, from an economy standpoint. But if you also got a Fed that cut interest rates 2, 3, 4 times, that would suggest that the Fed's actually pessimistic. They think the economy needs help, right? And we don't necessarily want that either. So we're in a point where if the market's sitting where it is today, if the Fed's sitting where it is, and they almost sit right on top of each other, if we can come to that equilibrium point and kind of sit there, that actually may be a good spot from a market standpoint to create a little bit more certainty. And we were talking about this at the very beginning. We've lived through plenty of uncertainty over the last 3 years. If we get to a point where there's a little bit more certainty or at least confidence around where interest rates are and maybe where they'll be for the next 3, 6, 9 months, that actually puts the market in a more stable position, which then allows for a little bit more strength from a market standpoint, which is, I would say, generally a good sign for investors.
And Austin, what typically happens once the Fed's done? I mean, I think that's
hold on, done raising interest rates, not
done raising interest rates,
not done as in dismantled.
Done. Wouldn't that be nice? No,
that would be a whole different conversation, Jim.
That'd be different.
We've had folks ask us if there should be a Fed at all. So we'll take that offline. Christina, that's a great point. History would tell us, and I think there's a chart later that we'll get to. History would tell us that when the Fed is done hiking interest rates, it's really a time that you want to own individual equities. Because what that tells you is, again, there's more confidence, there's more certainty from what does that mean for the market on a go-forward basis. Now, that's not to say that you need a portfolio that's only stocks by any stretch. You need a portfolio that fits your financial plan. And that's where working with a financial advisor like Christina or Shannon or Alyssa is extremely important. But the propensity or the desire to own stocks in a period where the Federal Reserve is done cutting rates is actually, a really good spot.
So let's talk about the under-levered consumer.
Yeah.
And first of all, what do you mean by under-levered consumer? Yeah. And how does that impact business? How does that impact the stock market?
Absolutely. So we've had a lot of conversations with folks really over the last, let's call it maybe 12 months at this point, that as you've heard this conversation about, are we going into a recession, right? Is this inflationary environment followed by, Fed hiking interest rates, is that going to push us into a recession? And really, if you take a step back and actually look at the consumer who, and for that matter, even the business side of the economy, but those are the two components that really drive the economy, right? And if that's the case, we need to look kind of under the hood and see what's the health of those component parts. And where we talk about an underlevered consumer, we got two charts on this page. Again, I'll describe them in a little bit of detail. Is let's look at the consumer's really interest payment that they're making on a monthly basis, whether that's a mortgage payment, whether that's a car payment, whether that's credit card payments. What type of interest consumer interest are you paying on a monthly basis relative to your compensation? So what percentage of that, right? Same thing on the corporate side. What percentage are you paying in interest of your total revenue, right? So everything you're bringing in, so whether that's compensation or revenue on the consumer side, what kind of interest are you paying? On the corporate side, what kind of interest are you paying? And both of those data sets would suggest that we are near, if not at, multi-decade lows, like going back to the 1970s, 1960s, right? And if that's the case, what does that tell you? Both the consumer and the corporation are extremely healthy, right? They're in a really good spot. Now, that doesn't mean that maybe there aren't still pain points for individuals. There aren't still pain points for individual companies. But think about where you were either personally or somebody you knew going into 2008, 2007, 2008, or for that matter, going into 2000, 2002. Or if, go back that far, think about where you were from a leverage perspective going into the late 80s, right? All of those are periods where folks were, to some extent, I say folks, individuals, consumers, but also corporations were over levered, right? They were out over their skis, whether they had taken on individually, too much debt in mortgages or, car payments or house payments or whatever it may be. From a business standpoint, had you taken on too much debt that you couldn't support as things really started to tighten down? If that's the case, then what we're seeing today is the exact opposite. You've actually got a consumer that's extremely healthy. You've got corporations that are extremely healthy. And what that tells us is those can be the component parts that actually carry the economy, even in the face of some of these headwinds that we're talking about with higher interest rates and that inflationary environment that we've seen over the last few years.
So is that why when I get on what used to be a business flight, commercial flight, it's full of tourists? They're not any business people traveling anymore, and you go to a hotel and it's 3 times as much as it used to be?
That's absolutely part of it, Jim. Yeah, I mean, I would say this: if you just look at individual balance statement or balance sheets, right,
Yeah.
and personal, like look at your personal balance sheet individually, it's actually in a really healthy spot on average. Again, I'm not going to speak for every individual person out there, and we've had these conversations with advisors again for the last 12 months. You've been in a position where if you're reading the headlines, if you're watching the news, they're telling you that inflation is at multi-decade highs. Interest rates are going to crush all of us. You're talking about pick your industry that's been hurt by the pandemic, right? It's all this negative information that we're being fed. And don't get me wrong, right? All of that is legitimate in some way, shape, or form. But take a step back and look at, okay, where's my checking account? Where does my investment account sit? Right? Yes, 2022 was maybe a tough year from an investment perspective, but take a step back and look at that relative to your financial plan. The data tells you that you're actually in a pretty good spot from a leverage perspective. We're not like we were going into a 2008 or going into a 2000, 2002. And what that tells you is the risk of kind of this catastrophic, 2008 all over again scenario is extremely low with where we sit today.
Austin, you need to be on TV, but if you keep talking like that, no one's ever going to put you on a news show because it's not, it's not doom and gloom. Right?
That's true. That's true.
Great Resignation appearing to be coming to an end. Interesting.
Yeah. No, and I think, Christine, I know we talked about this just yesterday when we were together in Vermont. I think what you're seeing is, and Jim, this goes back to what we talked a little bit about earlier. You had an environment where the labor markets were almost too healthy. And what I mean by that is if you wanted a job, you probably had 2 or 3 available that you could go get, right? Hiring was extremely tough. whether that was because money that had come in from the government during the COVID, period, right? Money that was basically pumped into the system allowed people a lot more flexibility around taking a job and then in essence leaving a job. The quits rate that we're looking at here basically says, are folks willing and actually, able to quit their job and very easily find it because they're very easily able to find a new job. What you're seeing is that's coming down, and that can be for a number of different reasons, right? Whether that's because inflation's coming down, so pay is maybe coming down as well. It's not as advantageous to go job hopping and look for higher pay. Whether that's because maybe you got locked into a low rate mortgage and you don't want to move at this point. Remote work seems to be maybe not entirely going away, but at least scaling back. So the idea of quitting your job and potentially having to move and give up that 3% interest rate that you had probably isn't reasonable at this point. So a lot of different factors here. But what you're seeing is a consumer and an individual in this case that's really being tied into those jobs a little bit more, which should help from a labor market perspective, the overall health of that environment, which I think is a pretty interesting thing to think about.
Yeah, I think it was interesting too, Austin, that I think you guys are not unique in a sense that many firms are kind of getting to a point where there's not a lot of remote work anymore. I know that you guys went back to 100% in the office, and I know my staff's 100% in the office and has been for quite some time, and it makes a difference in culture to make sure that the turnover rate goes down as well. So we're seeing a lot of major corporations kind of bring people back in the office.
Yep, absolutely.
Anita says, is the trade issue, in air quotes, affecting inflation as well? And what is the percent of trade affecting this?
Yeah, I think that's a great question, Anita. I would tell you what we saw during COVID actually put that to the forefront is maybe the easiest way to say it. And what it did is it forced companies to have to think about whether that's international trade and how they were doing that from a goods perspective when they were sourcing materials. You saw a lot of companies shift where they were getting materials from. Not surprisingly, China seemed like everybody left China, and I say everybody left. Not everybody actually left. There's still plenty of sourcing coming from China, but what you're seeing is a broadening out and a diversifying perspective of that. I think that's actually helped the overall environment. I would say there was absolutely a very early effect from an inflationary perspective, but it really hasn't been the driver of inflation, let's call it over the last 12 to 18 months. I think you could very easily point to that maybe in 2020, 2021 in terms of driving some of that inflationary measure. But I would tell you over the last 18 months at this point, companies have actually done a pretty good job, whether that's bringing things back to the US or within your respective country, or diversifying out that supply chain and not just entirely focusing on one specific country, one specific area. Whereas, again, China was a big supplier going into COVID. It's become less of kind of the holy grail, if you will. And whether that's other Asian countries, whether that's Latin American countries, even South American countries, you've seen this diversification of supply chain, which I think will help us in the long run. And you've seen that over the last, like I said, year and a half at this point, help and really not have an impact inflation-wise.
So we have another question, Anonymous. Now, Anonymous, who answered this question, you have there's a lot of like technical stuff in here. So you're either like, you're smart or licensed or well-read, whatever it is. Okay, so bear with me. Does market and Fed equilibrium, meaning what the market thinks interest rates are and what they are, which is, I think that's what that means. Does market and Fed rate equilibrium with a forward-looking pause in rate increases, meaning not many rate increases in the future or any, imply a belief that Congress and the president will put the brakes on fiscal policy for either A, spending, B, increasing taxes, or both? I'm going to answer that question and then I'll let you answer it.
Okay.
I don't think it implies anything.
Yep.
I think that Congress is always going to tax and spend, and that's the world that we're in. And I personally think taxes are going up, and I think spending is going up. But that's unfortunately, that's my realistic assessment. But I'll let you guys answer that.
And I'll say that whenever you have a divided government, which we do right now, and we're in the third term or the third year of a presidential term, you're not going to have major fiscal policy changes.
Yeah.
It's just not going to happen.
Yeah. Yeah, I would echo exactly what you guys just said. While maybe you could hope that was the case from an implication standpoint, Jim, I think I'm with you in that as much as we would like to believe that Congress would take a page out of kind of what the Fed's doing and act accordingly, or vice versa, they don't really act in coordination very well, and history would suggest that, and oftentimes they kind of butt heads a little bit. So
let me ask you: we have next year is the presidential cycle is, we're going to have a presidential election.
Yep.
And that's a year and a half from now, because we're in June of 2023, a year and a half ish. What generally happens in an election year historically? It's one about every 4 years, but what's generally, what has happened in the past?
Yeah. And this kind of goes to Christina's point. Anytime the government and Congress specifically stays out of the way, that's generally a good thing for markets. That's why kind of this idea of divided government that we've seen, and right now we're in the third year of the term. Next year we'll be in the last year. Their inability to make big changes, or their lack of a desire to make big changes, is actually good from a market perspective. Goes back to what we were talking a little bit about earlier. That just adds more confidence and more certainty from a market standpoint. If you're in the first or second year of a term, and you've got either a new president or a new Congress that's coming in and wanting to make an impact, markets tend to get a little bit uncertain there, because they're not sure exactly either what it's going to look like, how it's going to be, be responded to. Like, there are so many unknowns there that's challenging from a market perspective. To the extent that we have more certainty and more confidence there, that can actually be a pretty good thing.
Yep. This has been a fascinating slide, Austin, because I think the question that we're getting along the narrative of, there's a recession, the never ending, we've been talking about a recession coming for 18 months. And, we did have a recession. There was technically a recession in 2020. It was short. But when COVID hit, we did have a recession. And now it's the never ending headline of, are we going to have a recession? And the one thing that they kind of keep going to is we're seeing an increase in consumer debt. And I think that's really the reversion to the norm. And I'll let you kind of get into this, because I think this was fascinating.
Yeah, no, for sure. So if we're looking at, spending, whether that's entertainment, whether that's goods, whether that's services, yes, you've seen, things come down a little bit. But Christina, to your point, from a debt perspective, a little bit of what we just talked about, a few slides ago, you've actually seen kind of this reversion to normal, or reversion back to kind of the pace that we were on as an economy going into 2020. And why that's important is because this window, or this gap, whatever you want to call it, from 2020 to right about now, you had a market that was flooded with liquidity. And what that meant was you had no need for individuals to take out additional debt. You had no need for individuals to worry about how they were spending their money. That's part of why you saw the inflation the way we did, is because folks were flush with cash. And I say cash broadly. They were just flush with the ability to spend money. As we all know, many folks actually did better with some of the stimulus checks that were coming in 2020 and 2021, and they had excess kind of capacity to some extent, right? And their ability to spend was something that is measured in a slide like this, where we're looking at consumer spending. But then if you actually look at consumer debt and credit card debt and you name it, we could show a number of different data points on that to suggest that that actually almost kind of fell off the map. And what you've seen coming out of the last year or so is exactly what Christina said. We're getting back to kind of a normal environment where if you actually draw a trend line from, let's call it the last 5 years pre-COVID, and draw it right through the COVID period from a consumer debt standpoint, from a credit card usage standpoint, from a number of these measures, where we are today is really just right on trend with where we would have been had that trend continued from pre-COVID. Now it looks night and day different during COVID, but again, you just almost have to forget that ever happened and then say, okay, where we are today and where we were in 2019, the trend has continued and we're right on target. Now, looking at how we got there, it would probably blow your mind, right? But where we are today actually isn't nearly as bad as maybe the media wants you to believe. It maybe feels a lot worse than where we were during COVID, but that's more because COVID was a very special situation, if you want to think about it that way.
It's all a blur to me. I don't know about the two of you, but COVID, 3 years, it's like, where did that go? I feel sometimes like Rip Van Winkle,
Yep.
Wake up. What happened? What kind of world am I living in? All right, we have a few more questions here. David asks, do you guys see a need to shift from brick and mortar type holdings due to all the companies that are folding? So I'm thinking Bed Bath & Beyond, those type of companies. What about the brick and mortar? I mean, maybe that's
that's a great question, David. I think there's definitely a shift towards more, I would say, technology-based companies in terms of what the market is currently appreciating. Now, by no means am I telling you that there will never be, successful companies again in the brick and mortar, segment of the economy. I think there absolutely will and continue to be opportunities there over time. I think what you're seeing right now is the market is appreciating companies that at least have that flexibility to take advantage of some of the technology that has really come front and center over the last 3 years. So I think that's something that's being appreciated right now. But keep in mind, there will be times when the valuation that you're seeing in some of those brick and mortar companies, you actually saw it just recently with, Jim, you bring up Bed Bath & Beyond. The cost or the ability for those companies to just actually sell the physical merchandise and the physical locations was more than what the company was trading for. And so you almost think from a liquidation perspective, the stock itself, in many cases in that type of scenario, should be worth more, even if it were just going out of business, because you can turn around and sell the land and the buildings and the materials. So that's something that we all have to think about, is that valuation component. At some point, there will likely be a value where those brick and mortar companies become attractive again. It may not be today, but I'll sit here and say, I by no means would ever say, hey, just forget about them. They're never going to be useful again.
And I think when we say brick and mortar too, we have to caveat to what type of brick and mortar. I think when you're looking at, retail, certainly that's changed. You think of movie theaters, what that's going to look like over the next, 10 years for entertainment. But when you think of, restaurants, you think of grocery stores, urgent cares, Walgreens, those types of things. Those are more mission critical. So, you just have to kind of quantify what type of brick and mortar are we talking about.
Yeah. For sure.
Anonymous has a follow-up. This was the election divided government question. So hopefully the Fed's actions have time to work while we have divided government, rather than Congress or the president implementing policy that counters the Fed's efforts. Yeah, I mean, I think that's spot on. Anita asks, what do you think we need to get back to some area of a normal environment? I kind of feel like when I first started practicing, I talked to a lot of people who lived through World War II and were kind of adults before World War II and after. And everyone talks about before the war and after the war, meaning World War II, kind of like World War I in Europe. I kind of think it's like us a little bit with COVID, like, well, before COVID, this is the way things were done. And now it's after COVID. And I think normal is probably not what it was before COVID. That's just my opinion. And I don't, who am I to say, but that's my view. I think business has fundamentally changed. A lot of, not all companies, but a lot of these have fundamentally changed. You look at I think Amazon probably had more sales, right? During, but I was already buying on Amazon anyway. And then that permanently changes consumer behavior going forward. So
Yep.
do you think we'll get back to normal, whatever normal is?
No, I would agree, Jim, with kind of how you're categorizing it. And we say it this way internally, is that especially when you enter a life-changing event like COVID, which I think was probably life-changing for all of us in some way.
Yep.
The way you enter it is never going to be exactly the same way that you exit it. And what I mean by that is what was normal going in is not necessarily going to be normal going out, right? And that's what we're seeing, is to say that will we go back to normal? If normal is pre-COVID, Jim, to your point, I don't know that we're ever going to get back exactly like that. Now, are we going to form a new normal coming out of COVID? Absolutely. But it's 99%, I'm 99% sure it's going to look different than what it did in 2018, 2019, just because of how the world's changed, whether that's remote work, which we've talked a little bit about, while some companies have scaled back. I think it's here to stay, at least more broadly than it was 5 years ago at this point. You talk about Amazon, yes, there absolutely may be, a number of occupations that no longer exist after COVID, but there are other occupations that are much more valuable post-COVID, right? And I think those are the changes that we all have to work through to figure out, okay, what is normal coming out of COVID versus what was normal as we went into COVID.
And I think this is a good slide to segue into, Austin, is earnings per share. Because I think that's the one thing that at the end of the day, corporate earnings drive stock prices. It's not politics.
Yep.
The market could care less who's in office. Fiscal policy, certainly affects corporate earnings. So fiscal policy has an impact, absolutely. But corporate earnings drive stock prices. That is the simplest way to look at the market. And I think that this is fascinating because when, obviously there's still some hesitation and concern. We're still kind of cautiously optimistic of what the market's doing, because you have 8 companies really carrying the returns, and it's very concentrated in 8 companies that are leading the returns this year. It's not it's not broadly diversified across any one index that's carrying the returns year to date. And when you take out those top companies, those top 8 companies, handful of companies out of the S&P 500 earnings, the forward-looking earnings is about a 14 on the S&P. And so that, a lot of times clients will ask, the price earnings ratio on the PE ratio on the S&P 500 is too high. It's overvalued. Well, when we really strip out those 8 big names, it's actually at a very fair valuation. So I want you to kind of drill down on that, because I think that was encouraging.
Yeah, and Jim, to your question, so when Christine is talking about multiples, it's this idea for every dollar of earnings, how much should you, or is the market suggesting that you should be willing to pay for that dollar of earnings, right? And historically, let's say kind of the S&P 500 on average is probably somewhere between $18 and $20 per earnings, right? Again, on average for companies inside of that. Right now, you're maybe towards the higher end of that range in aggregate, but to Christina's point, if you actually look at the overwhelming majority of the companies in the S&P 500, the median, if we really want to get into our math here, remember, median is just like, the average is taking all of them and taking that kind of average. The median looks at, what is, if we line them all up, where's the middle of that, right? And what that means is that skews much lower. So right now, you're only, for those 490 companies, you're only having to pay, to Christina's point, about $14 per dollar of earnings, which would tell you that if we go back to normal for those 490 companies, that's a 30% increase. Now, I'm not going to sit here and tell you that the market's going to go up 30% because earnings are 30% undervalued, but there's absolutely some opportunity there from a valuation perspective for many companies that are out there that aren't necessarily those top 10 names, which may skew a little bit higher, if that makes sense.
So is there a fund that's like the S&P 490 It's like 11 through 500.
So, yeah, so there's a number of different ways to play that, right? There are funds or strategies out there, Jim, where they actually equal weight all 500 names.
Oh, wow.
So they're not market cap weighted. So in essence, what normally makes up 25-30% of the market maybe only makes up 10%. So in essence, you're kind of getting that benefit. But this kind of speaks to what Christina said, is if you actually look at earnings for those top kind of mega cap names,
yeah,
they have definitely gotten maybe out ahead of everybody else, which again may create some opportunity for the rest of the market if and when we see things start to catch up. And I think the next slide actually maybe does a pretty good job of highlighting that.
This is, for those of you listening and not watching, what we're looking at is, I don't know, 80% of the return is just a handful of stocks.
Yep.
And that means 20% of the return or thereabouts, 30% is, 495 companies or 490 companies, something like that.
Yep.
So
yeah,
it's really
Jim,
out of balance.
Yeah, we looked at it, and I would tell you, and you can run the numbers, obviously. Again, the top 10 stocks percentage-wise in the S&P 500 actually make up about 27%. But to your point, they've added 6% of the total return, of which the total return for the index is about 8.3, right? So 75%.
And this is as of April 27th.
End of April. So
hasn't
things are
changed,
a little
percentage-wise, hasn't changed much on the weighting.
All right,
but
so
if you run the numbers, Jim, that tells you that those other 490 stocks, on average, have basically returned like 2 basis points.
Yeah.
Right.
That's not a lot.
No, that's nothing.
2% return. Yeah. That's so when people say, oh, I want to hire a financial advisor, as long as that advisor beats the S&P 500. Okay. The one thing that's missing here, I think, is the risk and the volatility, right? 100%. So S&P 500 I think it's mentally, for me, when I think about investing just personally, and I see that number change every day, it kind of stresses me out. It's like looking at my Tesla, and when I put it on percentage mode and I like 73%, and then I drive to the store and now I'm 67%, I start getting stressed out. What are some, are there any life hacks? Like, just, this is for the people watching this who are consumers. What can we do to mitigate this sort of stress that we might feel about seeing these daily numbers? You see it on the news, headline, stock market down 8%. You think my net worth's down 8%. Tell me, what are some hacks? And Christina and Austin, I'll just open it up to you.
I would say it this way, and Christina, you probably have plenty of other, great ideas as well. Turn the TV off. Don't read the headlines. And what I mean by that is exactly what you're saying, Jim, is what the S&P 500 or the Dow Jones or the NASDAQ, or pick your index, that's scrolling across the bottom line of the nightly news, or, is there on CNBC or Fox News or whoever it may be. How does that actually affect your financial plan that you're working with a financial advisor with? Slim to none over the long term. Now, again, on a day-to-day basis, if you're pulling up your account value each and every day, you'll see that, today I made this, this many dollars, and yesterday I lost this many dollars. But I think taking a step back and actually thinking about the financial planning side of it, and that's why at Horizon, we're such big proponents of the financial advisors. And that's why, as a firm, we're committed to, we do not have end clients. So we're not working with retail clients. We're working with financial advisors to give them strategies and products that can help power those financial plans, because that's what really is going to work for the end client, not trying to time, when do I buy this stock and sell that stock? It's, how do I get from where I am at 40 years old to where I want to be when I want to retire at 65? That's the important part, not trying to figure out, like I said, when do I get in and when do I get out,
right,
so that I maximize the total return. If you're playing that game, history would tell you, unless you've got a crystal ball that none of the rest of us have, that's a losing proposition.
Yeah. Yep. Ultimately, going from accumulation of wealth to, we've talked about a lot on our webinars, Jim, to a distribution of wealth is a different strategy, and taxes matter. And a lot of times, dividends matter. Owning the actual underlying, if you were to just index over a 20-year time frame, your returns are going to be lower versus owning those individual stocks and clipping those dividends. And so, timing the market is the Market Timers Hall of Fame is an empty room, because you got to be right multiple times. And ultimately, risk adjusted returns matter. So how much risk, what's your experience? And so we had a client that we were looking at their holdings, and while they've done well and their returns have been, on par with the S&P and maybe slightly better than the S&P for the last decade, they've been taking on 5% more risk per year than they needed to. So if we could have done things different than just holding the index, we could have given them a smoother ride. So risk matters, and diversifying into different asset classes matters.
You make a point. If you're taking 5% more risk and you're not getting a corresponding return, that's not as good of a deal as reducing your risk. So let me say this another way. For if you're listening to this and because this is a very important point, if this is confusing to you, it's if you take risk on, typically in the market, there can be a reward for that, meaning a premium. You're going to get a higher return if you take a risk, but sometimes you just have more risk because of the structure of the portfolio, and you can de-risk it and get this a similar or same return just on a high level. So it's very important, this risk element. I think it is underreported, if you will. It is under discussed with clients. They just look at the nominal return without weighing the risk. So
one thing I would add there, Jim, is the other thing that I think a lot of people overlook is when we're talking about risk is what happens in let's call it a catastrophic environment. Right? When things go down 25, 30%, like they did in March of 2020. Right. And if you're in the S&P 500, right, you're going to capture most, if not all of that, right? An index-based product, right? And if that's the case, are you as the investor comfortable or willing to accept that level of volatility and that risk? Or are you going to decide, hey, I'm pulling the ripcord, I'm out. And if that's the case, it's easy to pull it on the way out to some extent, but it's almost impossible to get it right on the way back in as well.
Yeah.
Right. So that's something a lot of people don't think about and that can really blow up. We're talking about a financial plan that can blow up the plan, in that you may be able to get out in time to withstand whatever you're worried about. But if you don't get back in at the right time as well, then you miss out on that upside. And all of a sudden, you've cost yourself probably much more than you potentially even could have lost as part of that. So a smoother path with less risk may keep you as an individual investor from making a behavioral decision that you look back and end up regretting, right?
Yeah. And I think you're talking about timing the market. And if you're watching this or listening to this, if people could time the market, they would.
Right. But
seriously, if people could time the market, they would. I just don't, it's too random. We don't know what's going to happen in a given day. You simply don't know. So we have a few questions. With the SEC recently giving some more clarity on Bitcoin as a commodity and the buzz about BlackRock starting a Bitcoin ETF, what would it take for you guys to feel comfortable to put Bitcoin into some of your clients' portfolios? There's a regulatory issue on that. We do represent a number of our clients own crypto. Some of our clients are in companies that have a crypto offering. They work in these companies. What makes me personally nervous as a lawyer about crypto, I don't think the government wants us to have crypto, is the bottom line. It's like the government really doesn't want us to possess physical gold, just on a very high level. They don't, and it's taxed differently. There's a new Fed, it's a Federal Reserve digital currency. I think it's supposed to be coming out this summer. What is that? I can't remember the name of it. Do you remember it?
I don't remember the name off the top of my head, Jim, but what I would tell you is you're absolutely right, at least from our perspective. And the reason that the government doesn't want you to own crypto broadly is because they can't regulate it.
Yeah.
Yep.
Right.
And I think that proposes so much headwind for, when you're the regulatory target, there's a lot of risk there.
Yeah. And by the way, you, Austin and Christina, you guys are helping every day when you get up and go to work, you help to create efficient capital markets. And we have the best capital markets in the world in the United States. And the government really does not want to mess with that. And I think Bitcoin is a lot disruptive when it comes to that. So question is, buying treasury bills good financial planning at this time instead of buying stocks?
We were talking about that a little bit earlier,
Oh,
and I think that that's one of the things, because I know we've got a good 5 so minutes left. I want to make sure that we get time to answer questions and hit any remaining points that we want to make sure that we do talk about. But I think that that's an important component, and one of the things that short-term treasury bills for short-term needs, sure. I think that one of the things that we have to be mindful of is taxes. When you're looking at treasury bills for longer term timeframes, taxes do matter. And in California, when we have many clients that are paying 53% in taxes between state and federal, when you can get a California insured municipal bond that is investment grade and it's paying 4.5% double tax free, your tax equivalent yield on even a 3.5% California bond is going to be more tax efficient. You're going to end up keeping 7% or more in your pocket versus getting a 4 or a 5 for the short term. And then when we look at this on a broader scale, yield chasing money market funds, T-bills, because they're paying currently higher yields, we can all agree eventually rates are going to come down. We don't know when, and we don't know to what extent. And I think Horizon, Austin, you and I are in agreement that, the Fed's not going to cut to 0 when they do cut. Right. It might level out at like a 3, and we might get back to higher interest rates than we've seen in the last, decade or so. All that being said, as interest rates and the yield curve comes down and has a reversion to normal, you're going to get paid less to own those short-term instruments like T-bills, like money market funds, like CDs, like savings rates. And so those yields are going to come down. So as those come down, would you rather have owned stocks coming out of that rally, or maybe some corporate bonds or some municipal bonds where you can lock in a higher current yield that'll last longer? I think that's really the message, is you don't want to be caught in the 9th inning while you're at a high interest rate. You don't want to be caught yield chasing.
Yeah, no, completely agree.
Anonymous asks, do you think life insurance costs go higher as well? I think the question is that the cost of insurance is going higher. I think the cost of insurance went down, and is it kind of flat, or do the higher interest rates mean that life insurance is more expensive or less expensive?
Life insurance, we're actually seeing some increase in cost while interest rates are higher, and those insurance companies are making more on the reserves and the cash value of their policies because they're making less in stock market returns. And actually, the mortality and actuarial tables have come. The mortality rate has come down in age. People are living not as long over the last few years since COVID. So life expectancies have come down. Mortality costs have actually started to creep back up. So we're not really seeing a significant decrease in cost there.
John, client John, glad you could participate in this. The Nikkei has risen 30% for a lot of reasons, including Warren Buffett's comments. That has not been addressed here. Please comment on the Nikkei.
Yeah, you've seen that, John, over the last, I guess, little bit here. A lot of that has to do with some recent kind of market restructuring efforts that they've put in place. It's really been an attempt to entice kind of foreign investment, which has clearly paid off.
Yep. As
they're at kind of multi-decade highs at this point. I mean, that speaks a little bit to what we touched on earlier, coming through COVID. In terms of that supply chain kind of diversification. So I think that's helped. You've seen the benefits of that. Throw in the weak yen. I think that's contributed to it. I think I would tell you internally here at Horizon, we do think there's some opportunity internationally, Japan included, as we go through the remainder of 2023. But for the reasons that I just kind of listed out there, we think there's probably some opportunity there, maybe even over and above what we've already seen.
So a couple of things I want to make sure before you close, Jim. I want to make sure we kind of highlight that you don't ever want to accept that a recession is fact and that it's coming just because that's been the narrative that we've heard
because
for
they say so,
so
yeah.
long. And I think that there's a lot of good things happening in the economy with the strength of the labor market and things that we've discussed. So with that being said, because the Fed could create some uncertainty over the summer, whether they're in the ninth inning or not, if you are looking at the long term, not trying to time the market for the next 3 to 6 months, but if you're looking at this over the next 1, 3, 5 years, if you're dollar cost averaging, if your choice was to take all of your money in your portfolio and put it in the market today, versus dollar cost averaging in a little bit over time, what would be your recommendation, Austin?
Yeah, absolutely. And we touched a little bit on this earlier, Christina. We've got a bias towards stocks. We've got a bias towards owning kind of the market broadly. I mean, the slide was up here just a second ago, but coming off the back of if and when we get to that Fed pause, history would tell you that owning stocks is the place to be. The fact is that you're going to see that. If you look at the data over a much longer time period, history would suggest that there's benefits there too. And that speaks to what you need to drive a financial plan over not just 3 to 6 months, over not just 3 to 6 years, but over 20, 30, 40 years from a accumulation and a distribution perspective. So I think having that core component is extremely important. And Christina, that's where we at Horizon and I sitting here today would say owning stocks and fitting that into your financial plan, there's definitely some value there.
All right. Well, listen, Austin and Christina, thank you. Next week, we have How to Own Investment Real Estate, LLCs, Joint Tenancy, and more. It's going to be a great one. And the link there it's in our YouTube channel. If you're watching this on YouTube, please subscribe. And if you are watching this on YouTube, just keep watching because it's going to roll to another video right about now.